You ever wonder what really makes the stock price just shoot up one day, only to come crashing down the next? It can feel like a total mystery, right? Well, it's actually not. Let's break it all down.
I mean, you see it in the headlines all the time, right? A stock is soaring, or maybe it's plummeting, and it can feel, well, completely random. But really, it all comes down to two simple forces that are always at play. And by the end of this, I think you're going to see the market in a whole new light. So here's our game plan. First, we'll hit the basics of what a price even is. Then, we'll dive into that short-term chaos versus the long-term performance. And finally, we'll tie it all together to really get the difference between a stock's price and its actual value. All right, first things first. Let's get down to the absolute fundamentals. Before we can even talk about why prices move, we've got to be clear on what the stock market actually is.
The easiest way to think about it is like a giant auction. It's really just a place where people who want to buy a tiny piece of a company, a share, meet up with people who are looking to sell their piece. And every single time a trade happens, boom, a new price is set. It's actually that simple.
So here's the absolute key. It all boils down to plain old supply and demand. Just think about it. If a whole bunch of people suddenly want to buy a stock, but not many folks are selling, what happens? Well, the buyers have to offer more money to get their hands on those shares, and so the price goes up. Now flip that. If everyone is rushing to sell and there aren't many buyers, the sellers have to lower their price to make a deal. The price goes down. That's it. Every single price change you see is just this constant tug of war. Okay, that makes sense, right? Supply and demand. But what causes those sudden rushes to buy or sell in the first place? Well, here's where it gets interesting. In the short term, the stock market acts less like a serious business analysis and a whole lot more like a high school popularity contest. So much of the daily mood of the market is just driven by pure human emotion and breaking news. A positive headline drops, maybe there's a juicy rumor about a cool new product or a big economic announcement, and suddenly everyone gets excited and rushes to buy. On the other hand, a bit of bad news, some fear about a recession, or just general panic can cause a total stampede of selling. This is what creates all that day-to-day volatility. And trust me, that popularity contest can get wild. Just take a look at the S&P 500. Back in 2019, it was the cool kid on the block, surging over 31% on this huge wave of optimism. But rewind just about a decade earlier, during the financial crisis, fear totally took over, and it plummeted 43%. It's the same market, just driven by completely different emotions. And this is exactly why it's so crucial to be careful. When the whole crowd gets swept up in either fear or greed, it is so easy to get pulled right in with them. But let's be honest, making big decisions based on panic or hype, that's rarely a winning strategy. The real key is learning how to separate all that noise from the actual signal.
All right, so let's flip the coin and look at the other side of this. If the short term is that crazy popularity contest, then the long term, well, that's more like a detailed performance review. This is where all the daily drama starts to fade away, and what really matters comes into focus.
See, over months and years, a stock's price almost always starts to follow the actual performance of the company. You start asking the important questions. Is the company making more money? Are its sales actually growing? Is it a leader in its industry? How's the overall economy doing? These are the fundamentals. And a truly great company with growing profits will, over time, attract more and more investors. Its stock price will eventually rise to reflect that success.
And what's really fascinating is when you look at the market's history. I mean, we've had the tech bubble burst back in 2000, the huge global financial crisis in '08, and of course the pandemic in 2020. In the moment, each one of those felt like the absolute end of the world for investors. But then you zoom out, and suddenly those terrifying drops look more like little speed bumps on a long road that's mostly heading up. Despite all that short-term panic, the market's long-term story has pretty consistently been one of recovery and growth, all fueled by real innovation and actual progress.
Okay, so we've got these two really powerful forces pulling at the market, right? There's the daily emotional roller coaster, and then there's the slow, steady engine of actual business performance. So how in the world do they fit together? This right here is probably the most important idea to take away. That daily price you see flashing on the screen, that's the popularity contest. It's just the market's mood for the day. But the real underlying value of a company, that's determined by its long-term performance review. Now, sometimes the price and the value are pretty close, but other times a great company might be unpopular for a while, making its stock price a real bargain.
Or a company could get super popular with a price that's way, way higher than its actual performance really justifies. Okay, so after all that, what is the final takeaway? Let's boil it all down to the essentials.
Honestly, it really comes down to these two simple points. Number one, try not to get too caught up in the daily noise. All the ups and downs driven by headlines and hype. And number two, try to focus on the signal. That's the real fundamental strength of a company, because that is what drives value over the long haul. So there you have it. The mystery is pretty much solved. Stock prices aren't random at all. They're this fascinating, constant mix of short-term human psychology and long-term business reality. And just understanding the difference between those two, well, that's the first huge step toward becoming a smarter and way more confident investor.
Now you know the forces that move the market. Keep on learning, and you'll be on your way to investing with real confidence.